Hi, I'm Ant Joblin and welcome to Money Trees, the show where we break down financial top fives for you. Now, anyone who has ever sat in front of a stock chart with a fully funded brokerage account has had dreams of making a Hollywood trade, where they call the market perfectly and profits explode. In the real world, it doesn't usually work out like that, but for a few lucky traders, it did. Let's take a look at the top 5 trades of all time. At number 5, we have George Soros, the man who broke the Bank of England. This might not be the biggest trade of all time, but it's definitely the most famous. In 1992, the British economy appeared to be performing well. However, because it was a member of the European exchange rate mechanism, the pound had to remain within 6% against other currencies who operated within this system. The Bank of England's problem was that the German mark continued to perform strongly with low inflation, while Britain's inflation was almost treble, causing distortions in the currency market. The Bank of England's hope that the exchange rate mechanism would reduce inflation was spotted as a fallacy by George Soros and his quantum fund. Soros began to borrow heavily in order to short the pound, taking up a position that exceeded $4 billion in total. The Bank of England attempted to fight the inevitable and raised interest rates to an eye-watering 12%. This signaled to the market that there was big trouble with the pound stability, and the government swiftly realized that paying 12% interest with a struggling currency was going to get very expensive very quickly. Eventually, the Bank of England gave up trying to fight the market, and the pound collapsed 25% in a single day, now known as Black Wednesday. Soros walked away with $1 billion for his efforts, his legend status secured principally by this single trade. At number 4, we have Stanley Druckenmiller, the man often cited as being the brains behind Soros's sterling trade. Druckenmiller had been a trader since 1977 with great success, which is why Soros brought him on board at Quantum in 1988. His first play at betting on the Deutschmark occurred during the fall of the Berlin Wall. Markets had been very severe on the prospects of the East and West German reunification, and as a result, Druckenmiller felt that the mark was too cheap. Seeing the potential miscalculation and studying the strength in the economy, Druckenmiller began a multi-million-dollar bet on the mark to rally. This quickly increased to $2 billion following support from Soros, who was quick to support Druckenmiller's vision. Over the next few months, their position of a harsh forecast and a brighter future led to Druckenmiller's initial bet, bringing in returns of 60% and around $1 billion in profit. Kyle Bass comes in at number 3 with a trade that earned between $3 to $4 billion in profit. Kyle Bass was one of the biggest winners of the credit default swap trades that took place in 2007. Bass had been trading successfully for some time, but it was a wedding in Spain that began the chain of events leading to his greatest trade. A conversation with an investment banker from New York about the subprime CDO market resulted in Bass hiring a team of private investigators on his return from Spain to research the US mortgage market. Using the data, he ascertained which residential mortgage-backed securities were high risk and therefore most likely to default. He then did something that was almost unheard of. He began purchasing CDS contracts as a bet against the multi-trillion-dollar subprime mortgage market and therefore against the entire global financial system. Bass managed to convince additional investors to come on board, and the result was a near $4 billion profit for his hedge fund. Second on our list, we have John Paulson, who netted $4 billion in profit with his famous trade. Having set up his own hedge fund, Paulson & Co. in 1994 with $2 million, he expanded it to manage around $100 million by the middle of the decade. However, in the skewed reality of Wall Street, he wasn't seen as a large player. All this changed when Paulson and his analyst, Paolo Pellegrini, started to look into the US housing market. They managed to raise around $150 million and then persuaded the banks to sell them a whole heap of credit default swaps, which are effectively insurance against debt. Then they waited, and their theory paid off emphatically in 2007 as the big banks began to struggle. On some days, they were making over $1 billion a day. By the end of 2007, Paulson & Co. had made $15 billion and they hadn't finished. As the markets continued to collapse, Paulson raked in another $5 billion for the fund, and estimates put his own personal take at $4 billion. At number 1, we have David Tepper, who bet big on beleaguered banks, resulting in an astonishing $7 billion in profit. Now, if you can remember back to the aftermath of the crash in 2009, markets had collapsed and investors were depressed. Everything felt lost, and bank stocks were the last thing that anybody considered investing in, except for Tepper. While everyone else was distracted by what was happening in the moment, Tepper saw the long game and decided to move his fund into the most dangerous market in town, banking. Tepper made his play in early 2009 as the big banks' stocks were so depressed that many were convinced there would be further failures in coming months. Tepper, however, was convinced that the banks would rally after studying a government white paper released in February 2009 called the Financial Stability Plan, which was designed to shore up the banks. The government was buying bank stocks which would be converted into common shares at prices exceeding the current value. Tepper decided it was time to buy and purchase some of the biggest banks' common stocks at very low values in big numbers. Tepper's firm reportedly purchased Citigroup shares at 19 cents to the dollar and Bank of America at 12 cents to the dollar, in addition to roughly $1 billion worth of AIG's commercial mortgage securities at 9 cents on the dollar. He sat back throughout 2009 and watched them double, then treble, and in BOA's case, quadruple within a year. His fund ended up returning 132.7%, and by the end of the year to net, Tepper made a staggering $7 billion. The move was so gutsy it has almost become folklore, with some people claiming Tepper keeps a pair of brass testicles on his desk, a reflection of the mettle it took to enter that market at that time. That's all we have time for today. See you next week.